Alrosa, which is a major mining company from Russia here in London. They are going to have a presentation in the context of the Investor Day. It is not a secret that the Russian government is thinking about potential privatization of Alrosa. It may or may not happen. So even though this is a non-deal event, we all know that potentially there could be a privatization transaction down the line, but that obviously will depend on a number of factors. We have the new CEO of Alrosa, who was appointed last year, Mr. Andrei Zharkov, here with us, and his senior team. Mr. Zharkov will introduce them, and they will talk about the market, the prices, stocks, production, and financial performance of the company. As you know, the company, since its IPO in 2013, certainly has been one of the best performing Russian stocks. It was one of the best performing Russian stocks this year, and so we hope that you will find this presentation both informative and interesting. So with that, let me pass the floor to Andrei Zharkov to make an introduction and to take you through the presentation. Andrei Vyacheslavic.
So if you don't mind, I will be speaking from here, because if I stand over there, it's very much like a report that we usually make in Mirny. So if you don't mind, I will be sitting here. And first of all, thank you for coming, for your attention to our company. Probably most of you know, especially ladies who are present here, know that it's a unique diamond company with a unique resource base of around 600 million carats. So it's enough for at least 20 to 30 years of production. And I would like to remind that Alrosa is leader in production since 2009. So it's really a unique company in a unique industry, as I have already mentioned, with a unique resource base, and as Jan have just mentioned, with a unique investment opportunity for you. Sales of the company, you know that they're based on a solid long-term client base. Company has a coherent long-term strategy. First of all, I would like to introduce our team. So I really believe that we have one of the strongest team in the industry, and on my right hand is Igor Sobolev, who is Chief Operating Officer of the company, with at least 20 years experience in mining, managed all of our current underground mines projects, which are now in operation. And actually, thanks to him, we're diamond producing leader. I mean, we're a leading company in production. On my left is Igor Kulichik. So started in company since 2002 as head of treasury. So knows everything about money, knows everything about our company. As I usually say, so he was born in the company. Actually, his mother brought him to the main building in 2002, and right since this moment, no, I don't think that there is anybody else who knows more about the company. Andrei Rodionov, my advisor, also 20 years of experience in finance. So joined our team at the end of last year, and actually helps us to enhance our competence on financial side. Myself, I'm Chief Executive Officer. Andrei Zharkov was appointed at the end of April in 2015, and have experience in metals and mining, was part of the Norilsk Nickel, Rusal, started as a central bank as gold reserves management team. Actually was in this building in 1997 in gold vaults of JP Morgan at that time. Joined Alrosa from Ministry of Finance, namely State Depository of Precious Metals and Precious Stones, Gokhran of Russia, which is managing state reserves in precious stones, so was engaged in transactions, of course, with diamonds and with precious metals and so on. So let me cover following topics today, which is actually Alrosa's current state and future development. Igor Soblev will make an operational overview, and key financial results will be presented by Igor Kulichik. So let's proceed with overview. Probably most of you know all the key financials about the company, but still I would like to remind you that we have a very strong financial profile with growing revenue, growing EBITDA, record margin of 53% as a result of 2015, so leading in cash costs and everything. Decreasing leverage. Alrosa, as you can see once again, is a leader on a global diamond market with a share of 29% of worldwide production. Shareholders, you know that 44%. The Russian Federation, so is planning or considering sale of 10.9% from the stake. Republic of Sakha 25%, Yakutian district 8%, 23% is a free float. So what we can say about the market? I would like to say that in 2015, global luxury goods market continued to grow, albeit at a slower rate of 1 to 2% per year. Alrosa sales were affected by the slowdown of luxury goods market, especially by its jewelry segment. Jewelry segment followed the dynamics of luxury goods market, slowing down, but not significantly. As a response to this structural and cyclical challenge, in 2015, Alrosa, with the leading diamond producer, established Diamond Producer Association. In 2016, I mean, right in 2 months during Las Vegas show, the Diamond Producer Association is going to present its generic marketing program to address market slowdown, and we believe, and actually we are sure that it will drive the demand up in the following years. If we turn to diamonds themselves, we can see quite an interesting story. And what I'd like to say is that it's a different story from what we see in oil, nickel, aluminium, or iron ore markets in 2015. By the end of 2014, polishers in India accumulated surplus excess inventory of $2.7 billion. It was, of course, affecting consumption of the diamond market. But strategy of, I can say, respectfulness and production discipline followed by major market players such as Alrosa, De Beers, and others aimed to keep the diamond market in balance, helped polishers to reduce this excess inventory by the end of 2015. And actually, as we can see now, as a result of the first quarter, the story is with happy end. So we see quite good improvements in the very start of 2016. And another part of the story, if we can see at the price corrections that we had during 2015, I would say that it was only 15%. Maybe it sounds, yes, it's contradictory that it's only 15%, but still, if we compare with other commodity markets, So behind this 15% price decline is really huge work which was made by Alrosa and other market makers. So actually this 15% correction is a result of our sales policy. I mean, of a strong client base, long-term contracts. So if our sales were not based on long-term contracts, the price decrease could be worse up to 40%. Price over volume strategy which is followed by the company, self-discipline of producers. So only this helped us to keep the market in balance. I mean, really helped us to keep the price at this level. So what about the future? Future, I think, is brighter. So clouds are disappearing, women are happy, men buying diamonds to them. So destocking in midstream in 2015 started the recovery of market demand in 2016. So US statistics, which was issued a few days ago, shows that January sales, at least in the United States, are 6.3% higher on year-to-year terms. Consumption of demand jewelry is not decreasing, but still growing, but at a very moderate rate. Chinese problems, yes, they exist, but still we forecast steady growth of jewelry market at the rate of around from 2 to 4% annually, at least next 10 years. On supply side, despite plans of mining companies to increase production, it actually, as you can see, remains relatively flat. And although if we expect, and we actually expect some increase in production within next 2 or 3 years, after 2020, it will start going down due to depletion of the main presently operating mines. Outpacing, rough diamonds market is expected to be balanced in the midterm, we think, or with a small surplus. Demand is expected to exceed supply definitely after 2020, so it shows quite good perspective on the long term. Which actually very good news, not only for us, but for everyone, I mean, for every diamond producer. Once again, I would like to draw your attention to market overview in 2016. So, as I have already mentioned, there is certain evidence of market rebound in sales levels in January, February of the current year. Our sales policy in 2015, which we followed in 2015, resulted in destocking in midstream. We evidence at least 25% sales increase comparing with first 2 months of 2015 and 2014 as well. We are cautiously optimistic with potential for recovery and steady growth in the next 10 years. And so I would like to finish my presentation with following key points. Actually, these are the highlights of Alrosa's today's strategy. We are staying focused on diamonds with no plans to go on into another activities. Igor Sobolev will cover on operational efficiency part now. As for geological explorations, we are one of the biggest investors into geological exploration, both in replacement of our reserves in Russia and new prospects on new territories in Africa. And so marketing strategy, which is very important, we think, now is developed by Diamond Producer Association. But we also strongly believe that we have to do more and we can do more marketing of our own brand. We were successful in our non-core assets divestment program. We have sold 5 more companies in 2015 for more than 300 million rubles. We are planning to continue it further in 2016 with selling more non-core assets. So now I would like to pass the word to Igor for overview of production, where actually you know that we are extremely strong. Please, Igor, prove it if I'm mistaken.
Спасибо, Андрей Вячеславович.
Thank you, Andrei. Good morning, ladies and gentlemen. I would like to present our production overview, and I would like to start by saying once again, let's focus on what Mr. Zharkov has already explained. Our also features a unique resource base and unique fields as compared to other peers globally. Our also benefits from operating in fields where the ore grade allow for underground mining. Indeed, underground mining means higher operating costs by 6 to 9 times, but given how unique those fields are, if you rebase that cash cost from per ton basis of ore to per carat, you'll see that it's pretty much comparable to what our competition has. Let's take a look at page 17 of the presentation to showcase our locations, geographies, and key production facilities. Russia is represented in 2 regions of Russia. First and foremost, the Republic of Sakha, or Yakutia. It's an area in Siberia where most of our fields are focused. And then the region of Arkhangelsk. That's a new diamond-producing region where we have our affiliate called Sever Almaz. Sever Almaz is just starting their operations. They're early on the way. On top of that, it also holds a share at Katoka Mining in Africa, but their production is not consolidated in our numbers because we only benefit from dividends from Katoka. Alrosa's core assets feature total reserves of 600 million carats and total resources that could be converted to reserves following some geological exploration efforts exceed 900 million carats. Alrosa has in-house geological exploration teams, and our expectations of converting resources to reserves are mostly about Africa. That's where we are unfolding our geological exploration exercise, and by now we have already discovered some new kimberlite fields. 50% of total production comes from open pit mines. We have a total of 7, as you can see in the bottom left. 25% comes from underground mining operations, and another 21% are contributed by alluvial deposits. Alluvial deposits are developed by our 2 affiliates, Almazy Anabara and Nizhnelenskoye, operate seasonally in northern rivers. That's closer to the Arctic Ocean, hence the operations are seasonal. Alrosa's key operating metric, approved by the Supervisory Board, is 41 million carats of production to be reached by 2019. In the past decade, Alrosa has been investing very actively into going underground, hence construction of underground mines. By now, these newly launched and commissioned assets, the underground mines, have already produced some initial results. Our production capacities do enable Alrosa to go over 41 million carats as early as by 2017, but given the negative developments in the global markets, we are not pushing for that so far. We don't boost up production as we could to maintain certain balance in the market. Page 18 that you see on the screen now demonstrates that key assets featuring most contribution into the 41 million carats of potential production is a new facility we have in the region of Arkhangelsk, that's Sever Almaz. Their production capacity are to go up to more than 5 million carats by the year of 2021, and also the Udachny underground mine, the latest one, with 4 million tons of capacity per annum. So far we haven't had anything in that scale. The closest underground mine is Mir, with 1 million tons of ore, whereas Udachne has 4 million tons of ore, which is 4 times higher. Udachne has already been launched. We are already producing from the ore body, and we get some ore as we are driving the mine underground. Close to the end of the year, we'll have launched all the infrastructure, and that will enable Udachne to reach 4 million tons of ore by 2019, and that translates into slightly more than 5 million carats per annum. These two core assets will enable gradual increase in total Alrosa's production to 41 million carats. Page 19 gives an overview of these two assets and their development. Again, Udachne and Severalmaz are the key drivers behind our total production, which is to reach 41 million carats. Just as I explained, most of the investments have been made already. The underground mine of Udachne has already produced 300,000 tons of ore, and that happened in 2015. With Severalmaz, the open pit mine has reached a design capacity by now already. And then again, so far we are producing from the lower grade upper horizons, but 2017 will mark the time as we hit kimberlite ore, which will effectively take us closer to 5 million carats per annum with a finer grade. Before you ask, we added page 20 into the presentation to explain the mining method of Udachne underground. That is very different from the 3 other underground mines we operate. Those use the traditional cut and fill mining methods. That means we cut rock and ore and fill that empty space with concrete, whereas Udachne uses a system, a mining method that is more spread in the world, and that is block caving. This means we'll have a low cash cost per ton. That means quite a huge potential for cost savings. Let's continue to page 21 to discuss Alrosa's key operational results in 2015. We increased total production in 2015 by 6% vis-à-vis 2014. This page explains, and I would like to draw your attention to Q3 in particular. As we meet investors, we often get this question: why didn't you decrease your production volumes, even though the market situation was clearly negative, and you could see that on the sales side? Let me explain. Our business operates in remote regions of Siberia, and hence communication cannot be run all year round in terms of accessing those sites. So we have to do seasonal work. In Q3 is the key producing time, with all the materials summoned, all the people delivered, and so on and so forth. Hence, the increase in Q3 of 2015 is explained by this seasonality. Given that the negative developments in the market only paid in summertime, and we still expected some revival as early in September, with the unclear overall expectations and environment, and the fact that we would need to run extra costs to suspend operations, we decided not to go ahead with that. We did this in Q4, but nevertheless, given the previous periods, total production in 2015 still saw an increase of 6%. The production plan for 2016 has been approved by the Supervisory Board in the following way. As soon as we get results for Q1, and if we don't run any extra costs to suspend operations, which were already suspended for the winter, as at the end of Q1, we may take decision to reduce production in summertime. So far, we are collecting all the numbers to see our sales volumes, and then we may consider potential reduction of the production side to make it on par with the sales side. The key idea is not to increase our stocks. The stockpile, which was increased in the course of 2015, that is the key prerequisite, say, that we have for our production plan in 2016 as approved by the Supervisory Board. Page 22 now explains our efforts to streamline operations and the costs as well. One of the key cost optimization areas is divestment from non-core affiliates. As you can see from page 22, we had as many as 70 subsidiaries in 2009. Not all of them were related to diamond production at all. Our earlier strategy, that had been changed by now, did provide for a broader diversification efforts as we were to go into many other businesses, but for now the new strategy provides for core operations in diamond production only, hence we are divesting from non-core subsidiaries. In 2015 we sold 5 extra non-core assets, which include our captive bank and also captive hotel. So the target for 2016, the target for 2020 is to go down to the total number of 20 subsidiaries related to diamond production or other services which are directly auxiliary or related to core operations at Alrosa. On top of that, Alrosa also has a major program to restructure in-house operations that are not that related to core activities. Page 22 was about activities that had been carved out as independent entities already, whereas page 23 explains what we do to carve out those non-core operations from Alrosa itself. Since we operate in remote area, we were to provide, in the past, we were to provide all the auxiliary services to make Alrosa self-sufficient, and hence we had to run operations not typical for a mining business. For example, we ran an airline and also kindergartens for our staff. We also provided water, heat and housing to our employees living in those remote areas. The optimization program I'm talking about is targeted at carving out all those non-core related operations. Page 23 explains what we have achieved so far. We have restructured our airline to carve it out from the main business into an airline itself. Now it doesn't only depend on Alrosa's orders, and it does provide services to us at market prices. On top of that, we have negotiated it with the government, the federal government of the Russian Federation, to transfer 5 airports to federal ownership. Those airports provide logistics services to our settlements and areas of operations. Now they are run by the federal government, and these operations are not funded by Alrosa at all. Furthermore, we restructured our kindergarten education centers. Now these have been carved out into a dedicated non-commercial arm, which does get subsidies from Alrosa, but only to a degree. On top of that, they get subsidies from the Republican government in Yakutia to run their operations. On top of that, we have transferred our housing services and utilities over to local municipalities. By the end of the year, we expect to do the same for heat generation and water supply. This is a large-scale operation with a lot of focus on that from our operational management. On top of non-core divestment, Alrosa has a dedicated plan to reduce its operating costs in the core business as well. This is highly valued by McKinsey, an external advisor we invited to look into our technological level and operational cost as well. All these programs combined, if put together, enable Alrosa to run operations with a good operational outcome, also in terms of the operational costs. These efforts allow Alrosa to have some good operational margins. This concludes my section in the presentation. I'm happy to take your questions at a later point when we proceed to the Q&A. And now I would ask Mr. Igor Kulichik to explain the financial section. Good day, ladies and gentlemen. As you've heard from President Mr. Zharkov and also from the COO, our competences have demonstrated that our financial performance were quite good despite the not so good environment. You can see page 25 clearly explaining our financial results. As you all remember, 2015 marked a major FX fluctuations. So for your benefit and easier understanding, page 26 gives you a breakdown of our exchange rate sensitivity. You can see two conclusions to be made from page 26. Our revenue and EBITDA are pretty much pro rata dependent on the exchange rate, whereas our cost of sales and capital expenditures do have only slight exposure by no more than 20%. Let's continue with page 27 of the presentation. This page explains our diamond sales revenue analysis. Well, most of the contribution comes from gem quality of diamond sales. And then again, the decrease in sales volumes was pretty much offset by the increase in our revenue in ruble terms. Page 28 explains our cost of production breakdown. As you can see, the key driver behind our increased costs comes from the extraction tax. That's top left corner. The extraction tax is based on the diamond prices, which are set in dollars. The 59% increase in extraction tax payments is related not to the tax rate increase, but only FX change. Then wages, salaries, and other staff costs went up by 17%, mostly contributed by salaries and wages adjustment by the official rate of inflation as provided by the Ministry of Economic Development. Also, this increase sees a contribution as we started operations at Karpinskaya 1 pipe at Severalmaz and increased operations generally. Page 29 now gives you a breakdown of our EBITDA, which went up by 26% to reach 118 billion rubles. Now let's continue to page 30 to analyze our planned versus actual capex. You can see a 5% reduction year on year, and the most important driver behind our capex reduction comes from the successful completion and commissioning of a few major facilities such as Buty-Obinskaya, the Karpinskaya 1 pipe at Severalmaz, and the first phase of underground mine at Udachny. On top of that, 2015 saw early investment into two new facilities such as Zarya pipe open pit construction and access road construction to the new field of Verkhnemunskaya, 170 kilometers away from the city of Udachny. Page 31 now. This clearly explains Alrosa's debt structure. We stick to the traditional strategy at Alrosa to reduce and debt and deleverage gradually. We are now below 2 times in total debt to EBITDA, and the total debt stands at slightly more than $3 billion as at the start of this year. We would like to stick to the same tactics. In 2016, we'll repay 350 million as planned by maturity, and as you can see, our maturity profile in the bottom of the page will be repaying gradually looking ahead. Page 32 explains Alrosa's strong cash flow. This cash flow enables the company, even though to pay dividends. Even though we saw negative IFRS profit due to the FX fluctuations for the results of 2016, and we're going to do pretty much the same, and there's a good surprise coming for all of us, you and us too. All state-controlled entities are to pay not 25%, that's the previous government order, so not 35% as Auros's dividend policy saw, but 50%, according to the most recent decree by the government. So now we'll be paying 16 billion in total dividends, or 50% of our net income. Let that be a good tradition for now. Again, let me remind you, our dividend policy says Alrosa is to pay no less than 35% under IFRS, net income under IFRS, and just a few days before this investor day we had a working group meeting at Rosimущество, the Russian State Property Management Agency, which discussed potential policy for 2016. They considered a one-off payment of 50% of net income, and looking ahead in the future, Rosimущество is considering potential move of dividend flow to link it to cash flow rather than net income, be it IFRS or RAS. So many of you have asked about this. It may happen in the nearest future. This concludes our section by now, and we're happy to take your questions.
Так, а кто у нас будет модератором сессии? Да, давай я. А то мы не сможем понять, кого слушать.
Thank you.
Can you please introduce yourself?
Yes, Sergey Donskoy, SocGen. Should we ask questions in Russian and English? Which is better?
Да как?
Whichever is more convenient.
Yeah,
Then let me ask the question in Russian to make it simpler. I have 3 questions, if I may. Let's start with the capital expenditure plan. I'm referring to page 30 of the presentation. 2016, according to the chart that I'm looking at, you're going to see an increase in your capex, which will go down to by 2018, and it will further increase looking ahead to 2021. My question is, should you decide to reduce your production in 2016 vis-a-vis your original plan, would the capex number be lower than the figure we see currently in the 3rd bar? And then again, can you please explain generally why do you have a planned or expected increase in capex in 2016? Also, considering capex in the longer run, it is going up after 2018, but how is that explained? Does that mean you're going to develop new projects, or does that mean you'll have to invest more maintenance capex? That's my first group of questions, if I may put it this way. Thank you. This question is handled by Mr. Zharkov. Looking ahead in 2016, that's Verkhny Munskaya field, a new project of ours. Indeed, as you rightly put it, the base case of our budget does provide or does include all the costs. Also, it includes road construction cost to reach out to Verkhny Munskaya. But you rightly put it again, our 2016 budget does provide for several cases, several options. There is a certain point when we can decide, should the market situation not meet our expectations on the demand side for rough diamonds, we do provide for a potential reduction in production volumes by 5 million carats. This would lead to a reduced capex as well. I think Mr. Sobolev can give you more details on that. The key project contributing to an increase in capital expenditure for 2016 is the new field of Verkhny Munskaya. That one has 4 pipes with 2 open pit mines to be launched. The target date is 2018 for the commissioning. Now, why we increase our capex in 2016? The thing is, we already have the decision of the government of the Russian Federation, which has agreed to compensate us for the construction cost of a road that's 170 kilometers to take ore from Verkhny Munskaya to our existing beneficiation plant at Udachny. That's 8 billion rubles of investments 8 billion rubles of subsidy, which the government will pay to us as compensation for the raid construction, hence the increase in 2016 capex. We incur the capex first and then get compensated by the government. And then again, looking ahead, it's not about the maintenance capex. We do have an expected investment for new kimberlite field. Our geological teams have identified a new kimberlite field just 100 kilometers away from Mirny. If the market does develop favorably, then we may take decision to invest and develop this particular kimberlite field. If the situation remains more pessimistic trend-wise, then that investment is not happening. As early as that 2019 and onwards, we'll rather do further exploration efforts and prepare for future developments. Thank you. I have two more questions, if I may. By the year of 2021, you'll see a different production mix, with more volumes coming from the underground mine of Udachny and your open pit operations at Severalmaz. But does this change affect your diamond mix? Are you going to have larger stones or smaller stones, more expensive in terms of value per carat or less? And that's one question. And another question, if I'm not mistaken, you had a plan to remove the exports duty for rough diamonds exported from Russia, and that target was 2016. Is this plan still in effect, and when is it to come? And well, the page on the screen does demonstrate average grade of our ore as Severalmaz and Udachny develop. Well, our average grade goes down from 1 in 2016 to 0.9 looking ahead, and still our core producing areas that contribute most to our revenues will continue to run. Indeed, they are unique assets. The international pipe has a unique ore grade of 9 carats per ton, which is 6 to 8 times higher than the average global average. And 1 ton of ore contributes $1,700 in revenue at the international pipe. So all of our underground mines, except for Udachny, have a really high ore grade and unique ore. Hence, thanks to that, our production cost rebased per carat is pretty much on par with open pit mines. But indeed, these two large facilities at Udachny and Severalmaz do take the average ore grade somewhat down, but they are feasible in terms of production. It doesn't in any way mean inferior financial metrics. Responding to your second question about the export duty, indeed, the Russian Federation did commit, as it signed the WTO accession, to remove the 6.5% exports duty for rough diamonds by the end of 2016. That's the commitment. We can hardly comment. We have the WTO accession agreement, we have the commitment by the Russian Federation, but you can hardly question or also about it. It's not us who introduced the duty, it's not us who committed to remove the duty. So that's about tariff regulations and the customs policy. But the commitment is there in the WTO accession agreement. We confirm. Thank you.
Yes, thank you. Neri Talardo from Morgan Stanley. A few questions from my side. If you could go back to slide 30 on the capex, just to make sure I understand correctly. So you've substantially increased the investments in outer years relative to the previous guidance, and that's for potentially new mines that will come online after 2021. Does that mean you plan to grow production further from 41 million carats, or is it sort of to remain at the flat level? The second question is on slide 28.
Maybe should they answer the first question and we turn the slide?
Ну, так
Alrosa's strategy does provide for demand growth. Hence, we do look up to that growth. And then again, the supply side will have reduced by 2019 as some major fields globally will have depleted, such as Argyle, which is to be shut down by Rio Tinto as early as in 2020. Our strategy does target increased demand growth, and we will have to match that on the supply side. But anyway, decision on that investment will come 3 years before the actual investments, as you see on the slide. Should our expectations be not in line with reality, these decisions may be altered.
The cash cost by mine. If you were to compare the quality of diamonds coming from underground, open pit, and alluvial, would it maybe make the situation look different? Because obviously, just by looking at this chart, you'd say that alluvials are not as profitable as the other ones.
And the alluvial deposits, in terms of the operating margin, they are profitable. The cash cost is higher indeed, but the quality of diamonds obtained there is higher as well. Alluvial means natural beneficiations, effectively. There are natural traps, which means we don't get smaller industrial diamonds that we'll have to extract at our core producing fields. That means cost of production is higher, but the value of 1 carat in alluvial is higher as well because there are no small stones.
One question on the market, on the midstream. How do you think the midstream is feeling now after the measures that you've implemented in the second half? Are the financing problems still there? Are they being resolved? Are the risky practices that they were taking in 2013, 2014 still happening?
As we explained during the presentation, if you look at 2015, getting back to 2015, and what happened there, the key reason behind this excessive supply, excessive stock, or excessive inventories in midstream, I think this comes as a result from several years of issues that had been building up. This is related to the fact that for some years, financing, the easy financing, was easily available for midstream players, and then they had excessive expectations for the demand growth, which was in turn related to the dynamics of the Chinese market. What we have seen in China was this: the retail business increased their stocks, estimating some demand growth. Midstream players had easy credit available in India, so they didn't keep track of the situation. That pushed us to increase the prices, and that in turn led to lower margins in midstream, sometimes rendering their business unprofitable. Again, they expected new sales operations and new stores to be opened in China. Overall, this situation is typical not only of the diamond industry. A similar scenario could be observed in other industries as well. But frankly speaking, thank God, the diamond industry has a dedicated culture which had been built thanks to the efforts established first and foremost by De Beers many years ago, and then that is followed up by Alrosa and also Rio Tinto. Indeed, there are some risks added with new businesses who have joined this market, but their positioning is different somewhat in terms of positioning, in terms of sales and marketing. Overall, I think that the diamond market features this very unique benefit. Well, as you understand, we never try to align our policies with all the competitors, but you know how it works on the market. If you want to keep things in order, then you have to be in the same boat, or you have to be in the same train, as we say. You have to buy a ticket and you have to stay with the team. That's what we saw in 2015. And we see different numbers attached, but basically 2.7 billion is the value of the stockpile in midstream that comes from independent market analysts as well. On top of that, there are inventories in the retail block as well. This is not that true for the US, but that is true for China. Those stockpiles are not critical, I think. Now, what happened? In theory, well, what happened? At least we helped the midstream players, and part of their stocks moved upstream to us. Now, it's important to make sure that their easy loans, easy money, have been replaced by easy miners. That means that miners, producers, will not be resolving all their issues, because frankly speaking, in 2015 that cost us $1.5 billion in low revenues. We do communicate with midstream players very actively, and we must admit it. There are positive and also some negative elements. So the good thing is more than 80% of midstream is now focused in India, so at least you know whom to talk to. And again, frankly speaking, the cutters and polishers in India do see some market consolidation. I recently visited India together with my colleagues to talk to our partners and off-takers, and we see that consolidation taking place. Large players do not see issues by now. They confirm and acknowledge that the issues they had back in 2015 have been resolved, and we see that clearly as well through our sales too. No need for them to confirm anything. Now, having obtained some money in the first half of 2016, they acquired some stockpile of rough diamonds, and in the course of 3 months, those rough diamonds will be cut and polished into cut diamonds. And then the question is how that translates into retail. But getting back to some retail statistics, the US market seems to be doing well. We've seen a fair in Hong Kong, China, and according to what we hear from our clients, according to what we see in those fairs, the demand is reviving. Indeed, some retail chains saw some issues, but nothing drastic, really. There are different opinions on further demand dynamics in China. Some people say it's going to fall completely, but I don't think strategically the demand will be slumping that much. It may A, stabilize, and B, it may migrate from one type of product within our mix to another, but I don't think we could underestimate the consumption power. In China, they have 10 million weddings every year. I really don't believe they can slump. Well, the Chinese culture is not European culture in terms of consuming diamonds. They're closer to the US. There was a certain damage done that Arab countries and also Russia and also China saw in terms of consuming luxury goods like premium products which were used as gifts. I could see that clearly. There was an outflow of this from China, and we've seen a slowdown in such purchases. I've just talked to colleagues who have come from Basel. Basel is about premium luxury products, really. They have different margins as well. We should acknowledge that. It's double-digit or triple-digit margin, and they have some cushion to fall through. So the decline in premium products is different. I'm not saying Cartier is going to cut down their prices. This has never happened, and this is probably not going to happen. We all regret that for sure. But I am sure that conclusions will be drawn very quickly. Their margins on the retail side are similar to ours, and they have a cushion to go down to boost demand. I'm sure these market mechanisms will work. Now, for the upstream segment, we have set up the DPA. In May, we will launch a generic marketing program. We've had some concerns together with my colleagues whether this DPA could conflict with De Beers' Forever Mark program, but turns out they clearly understand there is no point to push for that alone. There is a party to be enjoyed by several players. Why would you want to pay alone? So everyone has to pay for themselves, you know, and there is no conflict of interest because of that. We're going to meet Lucia tomorrow, and we will discuss that in view of the Vegas show. Everyone agrees the marketing plan is very good. It's not only our opinion, that's what our key off-takers agree, based on the limited data they have. The idea is not just to draw funding. This money must come from our off-takers, not investors, obviously. They have the money and they want an instrument or a vehicle to invest into. And it is hardly possible to invest into Forever Mark by De Beers. There must be a joint program. It will be launched first in the US market, then China, then India, the three key drivers with good culture of consuming diamonds that needs to be supported and developed. With a clever marketing plan, that is a good thing to do, and that is a possibility. Obviously, you need to invest more to do this marketing in the US other than China and India, but that is still a possibility. Well, it's not that everything has slumped and no one's buying anything. You all have wives and girlfriends, and it's hard to explain it to them, I'm sure, that it's Mother's Day coming or her birthday is coming, and you tell her it's the economic crisis, I can hardly afford a gift. That's not what you say to a lady.
So several state officials have proposed boosting the mandatory payout ratio for state-owned companies to 50% in the context of the privatization efforts. Does the board support that move independent of any state decision? And what considerations does the board have in that respect? In addition, what's the company's view on privatization of part of the state's stake in the company, positives and negatives for the company and for shareholders? And then I have two smaller questions. Thank you.
По дивидендам.
Let me respond on the dividends. Given that our supervisory board has representatives of our shareholders, it would be very weird to see any conflict here, right? Because it's government officials saying that and government officials represented in our supervisory board. Why would the government representative on the board be against an increased dividend payout? The supervisory board represents the shareholders, and hence they are interested in increasing the dividend payout. Let me remind you the current shareholder structure. 44% of our stake are owned by the federal government, the Russian federal government. And the Russian federal government, sorry, let me start over again. Let's disregard any macro developments, state tasks to increase employment or whatever other politics. The key source of income that Alrosa can provide to the government is its dividends. There is a reason, because 100% of our income tax and extraction tax get to the budget of Yakutia. And the federal budget is effectively not getting any taxes from us. Rather, they pay to us as they compensate for the VAT. So with the current structure of the federal and regional budgets, the government is naturally interested in having an increased dividend flow from Alrosa. Now, for how long that is going to be their interest, 2, 5, 3 years or whatever, That's hard to tell, but given our capabilities, it seems only natural for Alrosa and the government to support high dividend yield. You know, our dividend policy provides for no less than 35%, and the government may well easily support a payout of up to 50% of IFRS net income, that's for sure. Now, speaking of the minority shareholders, obviously they are interested in an increased dividend flow for sure. But then again, potentially they discussed whether or not our net income could be cleared of FX effects when setting up the dividend flow. Well, we can discuss it. There are different opinions, and I agree in some situations this could take place because we've seen a major devaluation of the ruble, but in a year's time it may move back. So we need to take a closer look, given how strong our cash flow is. We can pay 50%, all right. If the situation does change, we may consider potentially to adjust our net income by the FX change. This is an issue raised at one point by minority shareholders. I would like to draw attention to that particularly. Responding to the privatization question, frankly, our key shareholders are not asking that question to us. There is a matter of budget revenue. Why do they need a privatization plan at all? Because they want to fill the budget. And in my personal view, this will definitely be good for the company because it will boost our liquidity and draw in new groups of investors. That is good for the company. That is good for our liquidity. And then again, as you see, new groups of shareholders with their own agenda, which see to it that you are efficient, that is definitely good for the business. Alrosa is growing towards more and more global business. In terms of an investment opportunity for you, well, it's hard for me to comment on that. Again, it's not because I'm the president or the CEO. In this environment, well, if you have an opportunity to come to a site visit, please do, because you'll need to see that we're a monster, huge business. It's too big to fail. Really, and in terms of its capitalization, it's very low if you compare that to Apple or other businesses. With the culture and the concentration that we have in the diamond business, you can hardly find anything. It's not seen in the iron ore. It's not seen in the fertilizers market. They tried to hold the blow for quite a long time, but now you see where the fertilizers market is. Our industry is unique in terms of understanding the market, in terms of the policy that market players stick to. Take Alrosa per se. Our client base is as large as possible, then efficiency. It's hard for you to imagine here how you can run operations at minus 50 degrees centigrade in winter, and in the same location you'll have plus 40 degrees centigrade in summertime. Consider the mechanical equipment, not to mention the people, by the way. Well, efficiency is definitely a difficult question to tackle, but again, you must understand that you cannot stop a vehicle's engine 24/7. So you can't just stop the engine if you don't want it to freeze to a point where you can no longer recover it. So you either park it in a heated garage or you never stop the engine, which is the case that we do with most of the equipment. And then again, we have lots of other issues related, housing and utilities, kindergartens, our own settlements that we run for our employees. We are too big to fail indeed, with more than 400,000 employees with families living together with them in the regions of our operations. They all depend on the success of our business. Nevertheless, we have decided to divest from non-core assets, and we are sticking to that policy. We have transferred all the airports. Then we sold the iron ore assets of Timir. We have transferred all the housing and utilities to local municipalities. Heat and power, as well as water supply, are being carved out into independent entities and removed from our balance sheet. So on top of the ambient temperature fluctuations, there is the issue of deliveries. It's just 2 months in a year when you have the time and possibility, physical possibility, to bring in all the goods and supplies. And then again, we have a response to that. We transfer vehicles from diesel fuel to gas fuel or power generation as well, from heat oil to gas again. Then beneficiation. We improve our beneficiation with new flotation methods. New underground mining method at Udachny. You cannot even imagine how much trouble we had with the state expert review. They didn't really want to give us a go-ahead with block caving method at Udachny. It does allow us to save a lot of money, and it's different from the traditional cut and fill that we use at the International, because you have to fill the space with concrete. That's a huge cost, and we no longer have it at Udachny. Alrosa is always looking up to the future. We try to improve across the board. We had an exercise run together with McKinsey to compare us against similar industries like nickel, like gold, and so on and so forth. We will be on the top 3 in terms of the benchmark. What do you think?
Well, short question, CFO. What is the share of costs that vary with respect to production in total cash costs? So, for example, if you would choose to reduce production by 5%, what percentage of total costs would we see fall?
Well, it's not a question that simple, as you might say. That's a very interesting question indeed, but it's not that straightforward. Managing production volumes and managing costs do not have that much of a linear relationship. As you've heard from Mr. Sobolev, the COO, we do have a plan B where we can potentially decrease our production volumes by 5%, by 5 million carats, not 5%, 5 million carats, if we don't produce from alluvial deposits. That is a very clear saving on the cost side, because we won't have to summon equipment and people into those seasonal operations. But then again, with production volume down, we see an increase in cost per carat, because the costs don't reduce pro rata, because, well, you have beneficiation, you have trucks, and so on and so forth. If you have low volumes, this doesn't translate into lower costs. As we go down on the production side, we do see the decrease in absolute cost, but costs per carat do go up. Let me follow up. Mr. Kulichik has rightly put it, but let me explain. There is a clear effect. We don't increase the stock. Continues Mr. Zharkov. Look, our target is not to increase the inventories. That's our key target for this year. Indeed, we did increase the stockpile back in 2015, because, as you've heard from Mr. Sobolev, the decision was to be made at a time when we had summoned all the equipment and the people, so we couldn't cut down on the production side in Q3. So our target for 2016 is not to increase the stockpile. We see some positive trends in Q1. The stockpile is somewhat down, but it may be seasonal as yet, so we are conservative, or conservatively optimistic, if I may put it this way. And then we'll take a closer look and see the effect of cost reduction, but cost per carat increase, and then again how that translates into the effect we'll see in the market and the market price. Like, if we produce an extra 5 million carats, then we'll add it to our stock, okay, but what happens then in terms of working capital investment, or we sell those 5 extra million carats in the market. How much pressure would that put on the price? That's a more complicated model, but then again, the decision is to be made at one point, as at the end of Q1, according to the decision of the supervisory board. But we clearly understand Q1 has the seasonality factor in it as well. Many people got their bonuses end of the year. They had some good time enjoying their vacations and spending money. Now the situation may be different. They may not have that much savings left to spend further. So Q1 is very often a seasonal thing in our business. Seasonal in a positive way, but then again, situation change. We do try to understand the market better at this point. But the good thing is, we are not just price takers. We are shaping that to the degree. At one point in time, we need to say it's price over volume. We keep the price. If needed, we can cut down on the production to see higher prices. But again, this is to be discussed. No decision has been made so far.
With green tie.
Спасибо.
Thank you. Let me follow up with some questions in Russian. I have several questions, and my first question is about your production volume and associated costs. Page 16 demonstrates an increase of production that is coming. Page 18 shows your increase in production, which will mostly come from underground, but underground production sees higher production costs as compared to open pit. And then again, your grade goes down year to year. So my question is, what kind of cost inflation do you foresee if you combine all the factors, consumer inflation or CPI, and also the change in your mix or your grade? Mr. Sobolev handles this question. Well, in 2016, the cost per carat in underground production is probably the highest as compared to other years looking ahead, because we have two major assets not yet fully up to their production capacity. We only produce 750,000 tons of ore at Mir, and in 2016 it will ramp up to 1 million tons of ore for the full year, but the increase, so that's plus 25%, but the increase in cost is just 12%. The same is true for Udachny. By now, Udachny underground mine has been pretty much priced in on the cost side, but their production volume was only 300 tons a year. That means a total operating loss because it is ramping up to full capacity. As soon as it gets higher, and the design target is 4 million tons of ore, there will be a lower cost per carat. So indeed, you're right, there is a certain cost inflation to be observed, but at the same time, we'll see the lowest underground production cost per unit by 2019, so that is basically lower than what you saw in 2015. We have constructed mining assets, and the cost per unit will be going down as they ramp up to full capacity. Question. So we can basically look at your cost inflation as pretty much at CPI inflation, right? Answer, yes, even somewhat better. And then again, 2015 saw a major effect from the ruble devaluation. If you take just two underground mines, which have been running for quite a number of years, I'm talking about Aihal and International. Our underground mines saw 54% of operating margin. That is 2015, but before 2015, It was 40%, that is before the devaluation. So I think that's the target you must be looking at. Another question then. I have a question on the diamond market. You've explained quite a lot, and you said earlier in the presentation that there was a 25% increase in volume in January-February 2016 vis-à-vis January and February 2015. That's page 14. How much of that comes from restocking and from the demand increase? What I mean is some retailers such as Tiffany show the results, and as they disclosed, they saw difficult situation in the global markets. Answer: yes, Tiffany showed, well, they didn't show a reduction in revenues, but they showed flat revenues according to most recent disclosure. That's how I understand that. But Signet does see an increase, and a number of other players too. Question: so you think Tiffany's results are not telling about the market? Answer: we need to look closer, because somewhere you have a devaluation of some sort, or I don't know, sometimes you see a lower inflow of tourists or whatnot. That's exactly what I'm saying. There will be demand migrating for sure, and you'll need to take a closer look at that. We see how it works. Sometimes there is more demand for cheaper, medium-sized products or smaller stones. Currently, this trend seems to have reversed. So there is more movement. The demand is always moving, I should say. As we explained, the premium segment, which suffered a blow following corruption or anti-corruption issues in China. Then again, the oil price went down, hence the Arab world was affected. Not about people or businesses running bust, it's about general attitudes. They're not that cheerful anymore. The same is true for Russia. Retailers can potentially boost their sales by taking down on their margins. Question: wouldn't they want to push you to reduce their margin as well, and the whole industry would contract? Answer: the margins are huge, really. It's premium products, and the margins are completely different. If you take premium product in a premium market, then discounts can be very high. For example, you have a Graffer Jacob with a sale price of $800,000. Well, now they're ready to sell at $200,000. So that's what they say. That's what retailers say. And I think if they really negotiate with a potential buyer, then 200,000 can go down to 100,000, and that's clearly seen by the customers. They visited. I don't know, yesterday and saw something at a price of 800,000, which could only be afforded by some upper classes. Now it's just 100,000. So I'm sure they won't go bust, Richmond or any other guys. No, that's not happening. That's a very clear story. And then again, you rightly put it. Take Tiffany, take Cartier. These are really pushing the midstream. The midstream guys come and say, there is a problem, no margins. They come to upstream players and say, give us a price cut of 10%. And we tell them, okay, we give you a discount of 10%, but then the retailers would press on you. They will take 9.5% out of that cut, and you'll come to us in 3 months' time and say, our margins are down. So moving the whole margin down to retailers is not an option. And midstream guys now clearly understand it. It's not about rough diamond prices being too high. The problem is with their industry. In midstream, That's what downstream, that is consolidation. The downstream is consolidated, the upstream is consolidated, but not the midstream. They're very competitive industry, but they are consolidating, and it will be developing down that road. What was your question again? You have answered my question, but I have another one, and then I'll give the microphone to my colleagues. I have a question on the dividends. You have the government decision to pay 50% for 2015 already, but as far as I understand, this is for 1 year only. Since Alrosa will most probably part of the privatization plan, don't you think that you need to do something more to make investors more confident? Because if you want to be one of the best players in the metals and mining industry in terms of the dividend yield, don't you want to have this 50% payout somehow put on paper so that investors are confident this will continue? Mr. Kulichik handling this question, I think I have touched upon that. The Russian Federal Property Management Agency Rosimущество is now considering how to change the dividend policies in state-controlled entities, and we put forth our suggestions because we communicate with investors and gather feedback. So most probably in the nearest years, the Property Management Agency will change the dividend policy to base that or link that to the cash flow, because the FX losses, the FX change will no longer be an issue, because currently with the FX losses taken into account, well, IFRS net income is very low, and then again, if the ruble gets stronger in 2016, we'll have very little IFRS net income. Not much dividend potential. So Rosimущество will then decide to move over to the cash flow to begin with, and then after that, most probably we'll move over to 50% for all state-controlled entities. That's the road Rosimущество is ready to take, and they're not hiding it. Mr. Zharkov, well, if there are no new projects in the pipeline, no one would want the company to have cash in the form of deposits or whatever. If there are some projects potentially available, that will be dialogue with investors. Mr. Kulichik, yes, if you have a high dividend flow, if high cash flow, we'll need to pay dividends or invest the money somewhere. There are no major mines on sale. No M&A targets was so 2017, 2018, we'll see high cash flow converted dividends.
You just answered most of my question, actually, but the suggestion was to look at free cash flow, because obviously net profit tends to be tends to contain a large non-cash portion, and pay out free cash flow in connection with your leverage restrictions. So the question which remains is, what is your leverage target in terms of net debt to EBITDA and so on?
Our net debt to EBITDA is comfortable at the level of 1. We're moving towards that gradually, and we will soon achieve that. I don't think it would make sense to take it down any much further. Our cash flow does allow us to go down to 0 leverage, but most probably both majority and minority shareholders will be happy with a leverage of 1 and then extract the rest of the cash flow as dividends.
Another question is related to privatization. I understand that you may not be involved 100% in this process, but in general, is there sort of dual track or 2 options to privatize on the market to multiple investors, or to sell to some single investor, say, quote-unquote strategic investor? What is the development in this?
Mr. Zharkov, well, there is not much discussion about that, although some consultation did take place. I really cannot imagine a strategic investor buying 10% of the business. I think what the government is now considering is a public placement. To multiple investors and well-known investment banks involved. So that's a good public story, and I think it makes most sense as we hear from the investment community. This is the kind of free floats the market will be happy to absorb. It's not that much of an issue. But again, the government will be considering a number of other factors too, like the equity market, in their dynamics, like the diamond market and the pricing environment, and then politically. So we'll see where we are closer to the placement window. It will be decided whether we have a go, and that decision will be made based on all those factors.
Is there any risk that reduction of state stake in the company can have some conflict with existing bond covenants?
У нас там ковенанты совокупные.
Our total covenant, our covenant is to make sure that it's 25 plus 25, so the covenants will not suffer. And then again, strategically, the situation is unique. With the placement, Alrosa will be more of a public company, but then again, government will still be interested in supporting the business. I really cannot compare Alrosa with any other business because we operate at home, frankly. You know, like being a home team in hockey or in basketball, it's always easier to play at home. The same is true here. Alrosa operates in Russia. That's our home. We're not doing that much in Africa. With all the benefits of those other locations. But here in Russia, you're always a priority in many respects. We do own assets in Angola, that's true, but it's different as compared to operations in Russia. We still work in Angola because we need to understand the prospects. As you've heard from our COO, Mr. Sobolev, we need to replace high-quality resource base, and most of the prospects are available there. If you compare Angola and Botswana in terms of the degree to which their territories have been explored, Angola is definitely more of an upside with a huge potential still unexplored. So we're not moving away from Angola. This cannot be discussed even. And then again, it's about establishing a strategic relationship. We keep communicating with the top officials at Angola, and we keep saying that again. Look up to Botswana or Namibia. The relationship must be strategic. And we have some good examples of that in Botswana. That's the story. It's all about strategic interest and strategic partnership. It's all about boosting the market cap. That's a global interest, I should say. That's the kind of spirit in which we have our discussions, and most probably we'll be moving along in that spirit as well.
Was first in line, and then we'll let you ask the question.
Edward Feritov, Bank of America Merrill Lynch. Thank you. I have a question to Mr. Zharkov. I remember what you said at the management call a few days back, end of last week. You mentioned there is a shift in demand for different types of stones within your mix, depending on the quality. Can you dwell upon the most recent site? What's the news? Answer by Mr. Zharkov. Well, we're going to see some numbers disclosed as at the end of Q1, but unofficially I can tell you that our sales team has sent in a coded message for me just this morning. The first quarter seems to be better than our original sales plan, and that is true for every month, each month in this quarter. So for the 3 months combined are better than the 3 months in 2015. So it's not only better than the budget, than our target for Q1, it's even better than the actual numbers we saw in Q1 2015. So it's pretty much on par with 2014, I guess. And that's the story for now. But again, we are very conservatively optimistic when assessing those results. We clearly understand that the second half of 2015 saw a decrease in volume of up to 40%. That was a dedicated effort to prioritize price over volume. We managed to maintain that balance of the market and keep the price. The cash seem to be available now. And the capacities on the retailer side and the cutters and polishers need to be increased. And then again, if cutters and polishers increase their capacity utilization, they will get cut diamonds as the outcome, as the final product. They will need to sell those to someone. And we are confident they do that with a view to orders coming from the retail side. If everything goes well, there will be no bottleneck in the midstream of the diamond pipeline. Overall, as we talk to clients, we think there is a surge for now, but in the second half there will be no correction that much. It will be flat demand, so it will stabilize. It will not boost that much, but will be more or less aligned. So we are cautiously optimistic. It will stabilize. The question is at what level. Question. Thank you. I have two follow-ups. Just to make sure I have got it right. You said at the management call that you see a slight decrease in demand for higher quality stones, and then I looked it up for the numbers of US retail, Tiffany versus Signet. Don't you think it's interrelated? Answer by Mr. Zharkov. That's true, as we discussed it. I call that demand migration, and it's always happening. Some stones are in high demand, others are in a lower demand. But then again, it's all about value on the one hand and price on the other, and what you want to promote. As we set the price before each site every month, it's more of an art, you know. Our colleagues from the sales team do see how much movement we have of a particular type of stones within our mix, and we see what we want to sell more, what we want to sell less, and the target is to keep sales in line with our production in terms of the mix distribution. That's the idea. And then again, Alrosa sells rough diamonds, not cut or polished diamonds. Then rough diamonds can be used in different ways. You can make smaller cut and polished stones, or larger cut and polished stones, be it 1 carat or be it 0.3 carats, and you make the same polished stones from one and the same, and you can make different polished stones from the same rough stone. So that's how it happens. You don't see it across the board. Overall, the mix is pretty much the same, but from period to period, there is some rebalancing, and that's how pricing works. Thank you. And my last question is about page 30. That's where you explain your capex. The change between 2016 and 2018 is effectively the 8 billion rubles that will be compensated to you by the government. So 2018 is net capex, right? Answer no. No, the 8 billion rubles are not factored in. The 2018 is our, targeted maintenance capex with no new projects coming online. The subsidy of 8 billion is not part of the capex plan. Question. So the 38.9 billion in 2016 is already does already include costs for the road construction, but no subsidy. So we have to spend our own money to compensate for the road construction, but that will be returned to us in 2018 as we launch the site. So in theory, 2018 capex number can be reduced by 8 billion, in theory. Mr. Sobolev, the 3-year capex of 2016 through 2018 could go down by 8 billion because we will be investing into both the road and the field itself in the course of 3 years.
Then we will conclude the formal part of the of today's event, and then there will be some time for people to ask questions in the foyer. Yes, please, sir.
Piers Killerley, RBC. 2 questions. Are you able to tell us the market value of goods in the Gochran that could be sold and give us some idea of when they might be sold? And could you also comment on pressure on Alrosa to encourage more cutting and polishing in Russia? Thank you.
Это секретная.
Well, that's a state secret. If I give you an answer, you'll have to fly back to Russia together with me. If you're ready to do that. But taking that question seriously, indeed, the Russian government budget does provide for budget deficit cover sources. If I'm not mistaken, that's the name of the line. It does provide for some money to add reserves at Gochran, and some money can be extracted from the Gochran reserves value. I cannot give the number precisely. If I'm not mistaken, in 2016, that number of Gochran sales as budget revenue can vary from 5 to 8, but no more than 8 billion rubles. That's 5 to 8 billion rubles within that range or so. But that's in terms of, again, value. This can include both diamonds and precious metals. There is no definite split of that 5 to 8 billion into precious metals or diamonds. It's up to the government and up to the Ministry of Finance. I really don't know. But 5 to 8 billion is the official number. It's part of the budget, which means no more than this number can be budget revenue. It may be adjusted within the year, but insignificantly. And then again, this is also true for how much Gochran spends to increase its reserves. I think they do have some amount allocated to buy diamonds from the market. It's still on the agenda. So far, we have not signed any agreement with Gochran as yet, but it's part of the plan. Then again, this is a regular effort by Gochran, because they have to make sure their reserves have a certain degree of liquidity, and they need to match all those KPIs of their own internally. Unlike them, unlike us, we don't. They don't sell on par with their production because they don't have any production. So they may want to sell a higher liquid part of their reserves or a low liquid part. They are interested in restocking somewhat to ensure high liquidity of the reserves overall. I cannot give you a number for the total value of diamonds in a state reserve because I have forgotten that number as soon as I left my office there. But frankly, this is not something relevant for the market today. It's not that scale. It's not hundreds of millions of carats. No, far from that. Not that size at all.
Last question, the lady.
Ksenia Mishan.
Ksenia Mishankina, UBS. Thank you for your presentation. You mentioned the degree of leverage. The target of leverage is 1, but when are you going to achieve that? Mr. Kolicek handles this question. If you take a look at our maturity profile, the total debt now stands at $3 billion. $1.7 million is our EBITDA. That means in 2 years' time we'll be closer to that leverage of 1. 2017 or 2018 will see us down to leverage of 1, and then together with majority shareholders we'll decide what we do next. Either we maintain the flat level of debt and repay dividends, or potentially we repay the debt further down to 0 by the year of 2020, which may not make that much sense, but still.
For joining, the team the management team of Alrosa will stay here for some time. There's a, coffee being served over there. So if, those of you who still want to ask them something or have any additional questions, please feel free.